Hi, all Inderes TV viewers. We released a new extensive report on Stockmann, and today we'll discuss about the company with our analyst Rauli Juva. Stockmann is a retail trade company with two chains, Stockmann department stores and Lindex fashion chain. Could you first tell us more about the company and its business model?
Yeah, sure. So like I said, there's two quite separate and distinctive divisions. So the Stockmann department store, which is geographically in Finland and Baltics, and then there's the Lindex chain, which is originates and still the biggest market is Sweden, and then the Nordics are a pretty dominant market, but they are also present in Central Europe and partially also globally through e-commerce. And the department stores is, if you look at the product mix, it's roughly half fashion and the other half comes from cosmetics, home products, and then they have own food department still in the Baltics, in Finland, that was sold already some years back. So that's not in their own hands anymore, even though some of the departments don't have a separate food section as well. And the department stores is selling basically external brands mostly. They have some own brands, like 10 to 20% of the sales, was most of it external. So very traditional retail in that sense, that they are buying products from other brands and then selling it onwards in their stores and e-com sites. And then in Lindex, it's mostly their own products. So they are sourcing them mostly from Asia and then selling them onwards, and their product range is basically only fashion, and that's split to kids wear and lingerie, which is the kind of base from which Lindex originates, and then there is some women's wear as well. So that's the products there. So that's in short the business model, I guess.
Yeah, thanks. Well, in September, the company announced that it's considering its strategic options for the Stockmann division and also changing its name to Lindex Group. Could this mean that the company will divest its department store business, and do we think that it would be a good solution?
Yeah, that's definitely one alternative which has been stated also by the company. And usually when companies announce these strategic considerations, it's often a kind of a code word for aiming to sell something. And in the Stockmann's case, we definitely believe that it would be and have been for quite a while a positive thing if they would divest the department stores, because it has been quite heavily loss making during the past decade. So getting rid of that would definitely be a good thing for the share. And the question has more been that who would want to buy it or take it, and is the company willing to kind of give it out for zero or even negative price. So that's maybe more of the question than whether it would be good or bad, but clearly they are, even if they have been promised to say something about this consideration during next year. But even if the divestment as such would not materialize in 24, they have clearly now, with the name change and this consideration, kind of chosen that the Index will be the core of the group going forward, and that the department store would be more of a kind of branch in the group, while historically it obviously has been the other way around due to the company name and heritage being in Stockmann and Lindex being acquired some 15 years ago to the group, even if for many years, like I said, the profit has come from Lindex and Stockmann department store has been making losses.
Yeah. Well, how is the market in Stockmann's industry, and how is the competition there?
Yeah, if we look, basically the fashion industry, I guess, as a group is the best thing to look at for Stockmann as a industry or competition. And there of course the competition is very wide and fragmented. So there are a lot of players and different kind of players and a lot of competition. So it's definitely probably one of the one of the more heavily competed industries in the world. And if we look at separately again on the department stores, there is well, Finns know, but for foreigners, there's a chain called Sokos in Finland, which is pretty similar. They are actually competing head to head only in a few places, like in the Helsinki center, but still, it's definitely the best peer in Finland. And then of course in fashion, otherwise both the department stores and Index are competing against a wide variety of different kind of players. You have the hypermarkets, you have the various kind of chains which you can find from the shopping centers. Kappahl being basically very similar to Lindex, also originating from Sweden, and then going to the more high-end boutiques, which is maybe more relevant competitor to some products for the department stores, then due to the price point being there higher. But yeah, that's the competition, and the industry as such is in the Nordics not really growing typically much, if at all. So the industry as such is pretty fiercely competitive.
Yeah. Well, how is the company's market position, and does it have any competitional advantages?
Yeah, the market position for depends a bit how you look at it. Of course, like I said, it's a fragmented industry, so the market shares as such are not huge for either one of the divisions. Lindex has in Sweden relatively big market share, like for instance in lingeries, but otherwise, in general, of the fashion markets, they are pretty small. So there is no dominant players in that respect. In terms of competitive advantage, like I said, Stockmann department store has been making losses for a decade. So it's hard to say that there would be any advantage as such when the business is doing so badly. But the brand is of course very well known, especially in Finland, and I think to some extent in the Baltics as well, so that has some value, but definitely no clear competitive advantage. Lindex, on the other hand, has been doing very well during the past few years, and even looking further back, they have been doing a decent returns on capital. So you could argue that there's definitely something they are doing right, and creating value, and hence having perhaps some competitive advantage. What is that precisely? It's hard to say. They have quite good competence and knowledge in the lingerie side, which is more profitable than the rest of the things, and a bit more technical as well. And especially during the current management over the past 5-6 years, they have been able to clearly improve the performance. So they have done clearly steps into the right direction. But if we think like sustainable competitive advantages, I think it's hard to say that the Lindex or any other clothing retailer would have such sustainable advantages, since it's a pretty dynamic industry, and also Lindex has its weak years also during the past 15 years under Stockmann ownership. There has been a very bad years as well. So there's no guarantee that those would come sometime in the future as well.
Yeah. Well, let's talk about the company's investment profile. What kind of value drivers and risk factors does the company have?
Yeah, the most obvious value driver is definitely the possible divestment of the department stores, because, like I said, it's still clearly loss making and contributing negatively to the value of the company as well, in our view, as we see the value for Lindex alone being above €4 per share, while the share price is now below 3. So if they would just give that out, it should have a quite clear positive impact to the share, and then on the kind of as a substitute for that, of course, they could then also operatively improve the department stores to at least be around break-even cash flow, so it wouldn't burden the valuation at least so much, but that would then take at least some years. And then on the Lindex side, it's more pretty much continuing what they are doing. They are now doing pretty good profits and creating value, and just continuing that will slowly create value for the company as well.
Yeah.
And the risk. Sorry, yeah. Well, the obvious risk is that the department stores would stay in the group and continue kind of destroying value and eating cash flow, and then the other risk which I mentioned already is that the fashion industry is quite volatile. Even if Lindex is more in the stable product groups to a large extent, it's still volatile, and also indexes and fiercely competed, like mentioned. So indexes result can sometime be clearly weaker than it's today.
Yeah. Well, how does the company strategy look like?
Yeah, there we need to look again separately on the Stockmann and Lindex division. They broke that out. That actually just like a month ago they had a CMD where those were announced. So for Lindex, it's quite clear cut and continuing pretty much what they have been doing. So growing internationally, growing especially e-commerce. They have a new logistics center coming online in the end of next year, which will enable them to be much more efficient and basically even just to push out more volumes through the e-commerce channels, so they can then be more active also with the global retailers, where they have some sales already today. So there is a pretty good steady growth outlook, I think, for Lindex. Nothing kind of explosive, a few percentage per year, but with this current EBIT margin being double digit, close to 15 now, that's definitely in the value creative zone. So I think that for Lindex strategy and outlook looks very good in that respect. For Stockmann division, it's a bit more blurry. They are definitely their kind of one key aim is to go more premium, to be more positioned in the premium and even in the luxury. And I'm a bit skeptical how much demand there is for such a player in Finnish and Baltics markets, given the department stores are still quite large in size. So they haven't talked basically anything about that. Will that need them to that the floor space would be clearly smaller today, or what other measures they have to improve the results to basically just to drive the top line, which they have been trying to do for quite a few years without much success. So that's I'm not so optimistic about the operative chances of the Stockmann division in improvement, and also the steps are a bit vague, like I said.
Yeah. Well, in 2021, the Helsinki District Court approved Stockmann's corporate restructuring program that would last 8 years. Could you tell a little bit more about this, and how has the situation progressed?
Yeah, indeed. Stockmann entered the restructuring when COVID started, and they kind of faced a risk that they would basically run out of cash, which in the end would not have been the case when you look at the numbers, but there was a clear risk to that. And that program was then confirmed in 21, like you said, and when most of that or the measures made there was some conversion of debt and then selling the real estate and paying debt with those was the kind of main measure in the program, and those were done already in end of 21 or during 21 and in spring 22 with the sale of the Helsinki real estate. So after that, the restructuring program has basically continued only due to the fact that there is some disputed claims from the previous or actually current landlords as well of Stockmann that are kind of litigating about how much compensation they should get when the Stockmann terminated the leases as part of the restructuring program, and we believe that the company should be able to kind of end some of the processes and come to some settlement agreements during next year, so that they would be able to actually end the restructuring program during 2024. But most likely, at least some of the court cases will go on longer. So if they will or could go longer if there's no settlement. So if if they are not able to settle, then that could stretch on even some years onwards, and that has a significance for the company because during the restructuring program they cannot pay dividends, and it's a bit harder to arrange financing, for example, and also to do some bigger investments or structural changes, even though I believe that they should be able to go forward with the divestment of the Stockmann division if they choose to do that, because the debtors should not oppose to loss-making business being divested out of the company, but it definitely creates some kind of additional hurdles to everything they are doing.
Yeah. Well, to continue with the same theme, how is the company's financial position overall?
Yeah, generally the financial position is good. It's good to note in Stockmann that they have a lot of this lease debt due to the IFRS 16 standard. So they have very long leases in these department stores they sold and leased back. And of course they have also a lot of other retail space as well, both in Lindex and department store, which they are leasing. So there's quite a big chunk of that. If you look at the balance sheet, and actual kind of financing debt is very limited. And if you look at the net debt, it's actually a bit negative. So they are in a net cash position, and hence the balance sheet as such is pretty good. And now with Lindex having created very good earnings already for a few years, the company is also creating quite good operative cash flows, even if that has been now directed to this logistics center investment I mentioned. But once that's finalized next year, the cash flow should also turn positive in the free cash flow level.
Yeah. Well, lastly, could you tell about our estimates and valuation at the moment?
Yeah, sure. So if we look at the estimates first, Stockmann has already twice upgraded their guidance this year, so they are having a good year definitely, and we believe that Lindex will be able to post their all-time high earnings, being over 90 million in EBIT, and Stockmann division will remain at a small loss on the EBIT level, and there we have to remember that a small loss in EBIT means actually a pretty hefty negative cash flow, because a big part of the rent cost is shown only in the financial costs. Then going forward, we actually believe that Lindex will be somewhat lower in the coming years, so around 80 million in EBIT, and then Stockmann will improve a bit to around zero EBIT, meaning again still kind of negative underlying earnings and cash flow. And then on the valuation, that's a pretty tricky part for this company, because there you have to adjust for these lease liabilities, and then you have net cash to some extent, which could be adjusted as well, and then you have these structural changes and loss, and you have this lease cost in the financials, and so that blurs quite a lot of the traditional multiples. So you kind of just kind of go and look the PE for this company and make any conclusion from that basically, but we have mostly focused on the sum of the parts now due to the kind of possibility of the department store divestment being very real, and there we have a bit increased now in this report the Lindex value, and in total that sum of the parts value is now at 4.0 euros per share, still having a small negative value for the department stores and group costs. And that's of course clearly higher than the current share price being below 3, but then we have to adjust also for the possibility that they wouldn't divest the department stores, or there could be something more negative happening, and what's the time frame for everything that materializing, and then with that and the other valuation measures we have come up with the 3.1 euro target price, and continuing with the accumulate rating on stock.
Yeah, thank you, Rauli, for the interview, and thank you all Inderes TV viewers. A reminder that the new extensive report on Stockmann is available on our website and also linked below. Remember to subscribe to our channel and give our video a thumbs up. We'll meet again in other videos. In the meanwhile, we hope you read analysis and make good investment decisions.